Okay, so we earlier saw about uh, the market's perspective and also the uncertainty principle, basically how consistent successful traders they make themselves available when the market is giving them opportunity, and that is the perspective which the consistent traders have, and they are consistently keeping their mind focused when the opportunity is given to them. And what exactly happens, uh, you know, they basically they and when the opportunity is there, they be in that zone. And the author also says that why what is the problem with the new traders to enter the zone is that because usually athletes and all these people they become enter the zone after a lot of effort which they put, and so even if we have to go to some new environment, we usually try to understand uh, the qualities of that particular environment. Say maybe we might learn the languages of that particular place, and then go and adapt ourselves in that environment. But when it comes to trading, what happens is we don't need any skill, and we simply we immediately get an account. Other one is we don't sit, we don't take time to trade. We can simply sit anywhere we want, and these are all the problems which we are facing. And so as a result, what happens is we don't put the mental effort needed. So and as a result, what is happening? The learning, whatever we learn, it is actually not we are unable to implement because of these kind of behaviors. So the market's most fundamental characteristic, it can express itself in an almost infinite combination of ways. The market, uh, oh, my screen is visible. Yeah. The market can do virtually anything at any time. This seems obvious enough, especially for anybody who has experienced a market that has displayed erratic and volatile price swings. The problem is that all of us have the tendency to take this characteristic for granted in ways that cause us to make the most fundamental trading errors over and over again. The fact is that if traders really believed that anything could happen at any time, there would be considerably fewer losers and more consistent winners. How do we know that virtually anything can happen? The fact is easy to establish. All we have to do is dissect the market into its component parts and look at how the parts operate. The most fundamental component of any market is its traders. Individual traders act as a force on prices, making them move by their bidding a price up or offering it lower. Excuse me. Why do traders bid a price up or offer it lower? To answer this question, we have to establish the reasons why people trade. There are many reasons and purposes behind a person's motivation to trade in any given market. However, for the purposes of this illustration, we don't have to know all the underlying reasons that compel any individual trader to act, because ultimately they all boil down to one reason and one purpose: to make money. We know this because there are only two things a trader can do: buy and sell, and there are two possible outcomes for every trade: profit or loss. Therefore, I think we can safely assume that regardless of one's reasons for trading, the bottom line is that everyone is looking for the same outcome, profits. And there are only two ways to create these profits, either buy low and sell high or sell high and buy low. If we assume that everyone wants to make money, then there is only one reason why any trader would bid a price up to the next highest level, because he believes he can sell whatever he is buying at a higher price at some point in the future. The same is true for the trader who is willing to sell something at a price that is less than the last posted price. He does it because he believes he can buy back whatever he's selling at a lower price at some point in the future. So here the author is so far is telling about how the market is, the fundamental characteristics of the market is to behave whatever way it wants. And to understand this behavior, we have to dissect the market. And the fundamental parts of the market is that we traders, right? We are trading, we are behaving, and we are acting as a force, just like how author said about the previous chapters about the force, the belief, the memory, and all these things. Here we are also acting as a force on the prices by either pushing up or putting it down. and uh, and there are many reasons why traders behave this way. But the fundamental thing is we all want to make money. And there are only two things which can happen. Either you can, two actions you can do, and two things, two outcomes which can happen. There are two cause and two effect. So either you can buy or you can sell, and you can make a profit or you can make it a loss. But everybody wants to make profits. Okay, so and there are few players, the buyers, what they do, they buy low and sell high. And then the sellers, they sell high and buy low. Okay, so the buyer believes that he is ready to pay a higher price because he knows that it will still appreciate further. And the seller, he is paying a lower price. He's selling at a lower price because he wants the price to go still much more low. Okay. If we look at the market's behavior as a function of price movement, and if price movement is a function of traders who are willing to bid prices up or offer them lower, then we can say that all price movement is a function of what traders believe about the future. To be more specific, all price movement is a function of what individual traders believe about what is high and low. So the market is behaving as a function of the price movement, and the price movement is behaving as a function of traders. And so and if it is only we who are moving the prices, and because the price is moving, the market is behaving. Okay, so every price movement is actually done by the traders. The underlying dynamics of market behavior are quite simple. Only three primary forces exist in any market: traders who believe the price is low, traders who believe the price is high, and traders who are watching and waiting to make up their minds about whether the price is low or high. Technically, the third group constitutes a potential force. Reasons that support any given trader's belief that something is high or low are usually irrelevant, because most people who trade act in an undisciplined, unorganized, haphazard, and random manner. So their reasons would not necessarily help anyone gain a better understanding of what is going on. But understanding what is going on isn't that difficult if you remember that all price movement or lack of movement is a function of the relative balance or imbalance between two primary forces. Traders who believe the price is going up and traders who believe the price is going down. If there is a balance between the two groups, prices will stagnate because each side will absorb the force of the other side's actions. If there is an imbalance, prices will move in the direction of the greater force, or the traders who have the stronger convictions in their beliefs about in what direction the price is going. So there are only three types of people possible. One set of people who believe the price is very high, another set who believe the price is very low, and the third set are the indecisive people who keep waiting to or make up their minds. And the author says that the third group constitutes a potential force. Okay, the reasons that support any given trader's belief that something is high or low are usually irrelevant. Okay, each and every trader will someone will tell their price is high, some will tell price is low, and those reasons are irrelevant because at the end, we all the traders, most majority of the traders, they behave in an undisciplined, unorganized, haphazard, and random manner. Most people trade. Okay, so their reasons wouldn't necessarily help anyone gain a better understanding of what is going on. So you can tell this will happen, and that will happen. But since majority of the traders are very chaotic, whatever reasons they tell, it is not of any use. But if you try to understand what is going on, it is not very difficult. As he said in the previous thing, the market behavior is dependent on the price movement, and the price movement is dependent on the traders. So if the market is not moving in any direction, basically the bulls and bears are balancing out each other. And as a result, what will happen? The prices will stagnate. And because whatever one guy will do, the other guy will absorb. Okay. Now I want to ask yourself, what is going to stop virtually anything from happening at any time? Other than exchange imposed limits on price movements, there is nothing to stop the price of an issue from going as high or low as whatever some trader in the world believes is possible. If, of course, the trader is willing to act on that belief, so the range of the market's behavior in its collective form is limited only by the most extreme beliefs about what is high and what is low held by any given individual participating in that market. So, I think the implications are self-evident. There can be extreme diversity of beliefs present in any given market in any given moment, making virtually anything possible. Now, the author is telling that, you understood the forces between the bulls and bears or whatever. Now, the author is telling what is stopping the price from moving, and other than, exchange imposed limits, say, for example, the upper circuit or lower circuit. Nothing is going to stop the price from going whatever direction it wants to. And so the range of the market's behavior in its collective form is only limited by the most extreme beliefs about what is high and what is low. So because at the one end of the high extreme, there will be very few people, and beyond that there won't be any people. So the market price won't go beyond that. Similarly, at one end of the other end of the what's it called, spectrum, there will be very low, and beyond that also it won't go any further. So when we look at market from this perspective, it is easy to see that every potential trader who is willing to express his beliefs about the future becomes a market variable. On a more personal level, this means that it only takes one other trader anywhere in the world to negate the positive potential of your trade. Put another way, it takes only one other trader to negate what you believe about what is high or what is low. That's all, only one. Here is an example to illustrate the point. Several years ago, a trader came to me for help. He was an excellent market analyst. In fact, he was one of the best I've ever met. But after years of frustration, during which he lost all his money and a lot of other people's money, he was finally ready to admit that as a trader, he left a lot to be desired. After talking to him for a while, I determined that a number of serious psychological obstacles were preventing him from being successful. One of the most troublesome obstacles was that He was a know-it-all and extremely arrogant, making it impossible for him to achieve the degree of mental flexibility required to trade effectively. Okay, so the author says that each and every one of us we can actually be a market variable, and what exactly happens is that each one of us can push the market in either direction. And to illustrate this, the author says about his a friend or some trader who came to him, and he was a market analyst, but he lost all the money and a lot of other people's money also. And he admitted that his life as a trader was not so great. And but after talking to this particular person, the author understood that there were certain psychological obstacles. The one important obstacles is that he was a know-it-all, I know everything, and extremely arrogant behavior. And because of that, he is unable to achieve that mental flexibility that is required to trade effectively. It didn't matter how good an analyst he was. When he came to me, he was so desperate for money and help that he was willing to consider anything. The first suggestion I made was that instead of looking for another investor to back what ultimately would be another failed attempt at trading, he would be better off taking a job, doing something he was truly good at. He could be paid a steady income while working through his problems and at the same time provide someone with a worthwhile service. He took my advice and quickly found a position as a technical analyst with a fairly substantial brokerage house and clearing firm in Chicago. The semi retired chairman of the board of the brokerage firm was a long-time trader with nearly 40 years of experience in the grain pits at the Chicago Board of Trade. He did not know much about technical analysis because he never needed it to make money on the floor. But he no longer traded on the floor and found the transition to trading from a screen difficult and somewhat mysterious. So he asked the firm's newly acquired star technical analyst to sit with him during the trading day and teach him technical trading. The new hire jumped at the opportunity to show off his abilities to such an experienced and successful trader. The analyst was using a method called point and line, developed by Charlie Drummond. Among other things, point and line can accurately define support and resistance. One day, as the two of them were watching the soybean market together, the analyst had projected major support and resistance points from the market happened to be and the market happened to be trading between these 2 points. As a technical analyst was explaining to the chairman of the chairman the significance of these 2 points, he stated in very emphatic, almost absolute terms that if market goes up to resistance, it will stop and reverse. And if the market goes down to support, it will also stop and reverse. Then he explained that if the market went down to the price level he has calculated as support, his calculations indicated that would also be the low of the day. As they sat there, the bean market was slowly trending down to the price the analyst said it would be the support or low of the day. When it finally got there, the chairman looked over to the analyst and said, "This is where the market is supposed to stop and go higher, right?" The analyst responded, "Absolutely, this is the low of the day." "That's bullshit," the chairman retorted. "Watch this." He picks up the phone, called one of the clerks handling orders for the soybean pit and said, "Sell 2 million beans at the market." Within 30 seconds after he placed the order, the soybean market dropped 10 cents a bushel. The chairman turned to look at the horrified expression on the analyst's face. Calmly, he asked, "Now, where did you say the market was going to stop? If I can do that, anyone can." The point is that from our own individual perspective as observers of the market, anything can happen, and it takes only one trader to do it. This is the hard, cold reality of trading that only the very best traders have embraced and accepted with no internal conflict. How do I know this? Because only the best traders consistently predefine their risks before entering a trade. Only the best traders cut their losses without reservation or hesitation when the market tells them the trade is not working. And only the best traders have an organized, systematic money management regimen for taking profits when the market goes in the direction of their trades. Okay. Uh, yeah. So here the author is telling to the particular trader about the how he was actually arrogant. And he asked him to take a job, and he took a job in some firm as a technical analyst. And the chairman of that analyst firm had no experience in technical analysis because he was a floor trader. And the analyst was using a method called point and line. He said that will he marked the support and resistance, and analyst was telling it will, by the time the price was about to reach the support, the analyst said that it will reverse. And when it reached his line, the author asked, sorry, the chairman asked the trader again whether is this the line up beyond which it will not go down. And the analyst was telling very positively, absolutely, this is the low. And the chairman is now telling that it's bullshit. And he took a phone and he asked his floor traders to sell 2 billion beans. And within 30 seconds, the entire market dropped. And now the chairman asked the, what is it called, analyst, if I can do it, anybody can do it. And the reason why the author is telling the story is that uh, anything can happen, and any one trader can make that change. Okay, so this is the cold reality which the best traders have understood and accepted. Okay, without any conflict, they keep telling that it can go in any direction, and that is how it is. And when it is before, so as a result, what they do to handle these kind of things, before they enter a trade itself, they will predefine their risk. So today, this is what I'm going to risk, something like that. And when they have losses, they will cut it without any reservation and tell that the market trade is not working. Okay, and the best traders have organized systematic money management regimen for taking profits when the market goes in direction of their trade. Okay, so not predefining your risk, not cutting your losses, or not systematically taking profits are the three most common and usually the most costly trading errors you can make. Okay, only the best traders have eliminated these errors from their trading. At some point in their careers, they learn to believe without a shred of doubt that anything can happen and to always account for what they don't know, for the unexpected. Remember that there are only two forces that cause prices to move: traders who believe the markets are going up and traders who believe the markets are going down. At any given moment, we can see who has the stronger conviction by observing where the market is now relative to where it was at some previous moment. If a recognizable pattern is present, that pattern may repeat itself, giving us an indication of where the market is headed. This is our edge, something we know. Okay, so the author is telling that you have to predefine your risk, and if you have to predefine your losses, and you have to systematically take profits. If you don't do all these three things, this is the reason why we fail in trading. Okay, so and the best traders, they have eliminated these things, right? And they have basically said to themselves that anything can happen, and they always have to there will be, although they might have studied a lot of things, there is always going to be something which is unexpected, and they have basically accounted that as well. And the author also says that there are only two forces for the prices to move. So one is some traders are going to believe that the market is going up. Some traders are going to believe that market is going down. So here is where the belief part comes, just like how he said about the memory and the belief. The force, that is the force, right? So that is why he has mentioned specifically as the true force. And whichever is stronger, we can always see. If it is going up and up and up, it means the people who believe the market, the traders who believe the market will go up, they are stronger. And if it goes down and down, then also we know that the traders who are thinking the market will go, they are stronger. Okay. But in this process of up and down, we can recognize some patterns, and that is our edge, right? We can have some candlestick pattern, can have some chart patterns, and that is what our technical analysis comes into picture. But there is also much that we don't know, and we will never know unless we learn how to read minds. For instance, do we know that how many traders may be sitting on the sidelines and about to enter the market? Do we know how many of them want to buy and how many of them want to sell, or how many shares they are willing to buy or sell? What about the traders whose participation is already reflected in the current price? At any given moment, how many of them are about to change their minds and exit their positions? If they do, how long will they stay out of the market? Okay. And if and when they do come back into the market, in what direction will they cast their votes? So we know that two people, one who expect one set of traders will expect the price to go up, other set of traders will expect the price to go down. And but there is a third set of people who are who will be sitting, who will not be doing anything, who will be thinking whether to enter or not. And in that, how many set of people are going to buy and how many people are going to sell, and how many quantity of that buying and selling, and how many will change their minds, how many will exit their position, how long they will be there. These kind of unknown variables are there, right? So these are the constant, never-ending, unknown hidden variables that are always operating in our market. Always. The best traders don't try to hide from these unknown variables by pretending they don't exist, nor do they try to intellectualize or rationalize them away through market analysis. Quite the contrary, the best traders take these variables into account, factoring them into every component of their trading regimes. So these are all things which are very scary. Like anything can happen. And the best traders, what they do, they don't try to escape from these things. They know that they have to face these things, and they basically take these things into account. Okay. For the typical trader, just the opposite is true. He trades from the perspective that what he can't see, hear, or feel must not exist. What other explanation could account for his behavior? If he really believed in the existence of all the hidden variables that have the potential to act on prices in any given moment, then he would also have to believe that every trade has an uncertain outcome. And if every trade truly has an uncertain outcome, then how could he ever justify or talk himself into not predefining his risk, cutting his losses, or having some systematic way to take profits? Given the circumstances, not adhering to these fundamental principles is the equivalent of committing financial and emotional suicide. So the author is telling that usually the best traders take all these things into account. And as a result, what they do, they predefine their risk, they cut their losses, and they take the profits. But typical trader, what he will do the opposite. Okay, and he basically trades from the perspective that whatever he cannot see or hear or feel, they should not exist. Okay. So, but we know that each and every trader can influence the movement of the price, and there are a lot of hidden factors which will basically make the outcome not so great. And if that is the case, then how can you not adhere to these three fundamental principles? That is, not predefining your risk, not cutting your losses, and not taking profits. Okay, and if you don't follow these three principles, it's equivalent to not adhering to these three is equivalent to committing financial and emotional suicide. Since most traders don't adhere to these principles, are we to assume that their true underlying motivation for trading is to destroy themselves? It's certainly possible, but I think the percentage of traders who either consciously or subconsciously want to rid themselves of their money or hurt themselves in some way is extremely small. So if financial suicide is not the predominant reason, then what could keep someone from doing something that would otherwise make absolute perfect sense? The answer is quite simple. The typical trader does not predefine his risk, cut his losses, or systematically take profits because the typical trader does not believe it is necessary. Okay. The only reason he would believe it isn't necessary is that he believes he already knows what is going to happen next, based on what he perceives is happening in any given now moment. If he already knows, then there is really no reason to adhere to these principles. Believing, assuming, or thinking that he knows will be the cause of virtually every trading error he has the potential to make, with the exception of those errors that are the results of not believing that he deserves the money. Okay. So why the typical trader will not commit to these three fundamental principles? Because he thinks that uh, it is not necessary. And why he thinks that it's not necessary? Because he believes that he already knows what is going to happen in the future, and based on what he perceives in his current moment, right? And because he already knows what is going to happen, he believes that there is no reason to adhere to these principles, and because of this all I know everything attitude, right? He knows, because believing, assuming, or thinking he knows, that will be actually the root cause of his trading errors, okay, which he has the potential to make. And that is what author is telling. So the three things, very important three things, are the not predefining your risk, not cutting your losses, and not taking profits. These three important things are some things which best traders they do before taking any trade and after taking any trade. Our beliefs about what is true and real are very powerful inner forces. They control every aspect of how we interact with the markets, from our perceptions, interpretations, decisions, actions, and expectations to our feelings about the results. It is extremely difficult to act in a way that contradicts what we believe to be true. In some cases, depending on the strength of the belief, it can be next to impossible to do anything that violates the integrity of a belief. What a typical trader does not realize is that he needs an inner mechanism in the form of some powerful beliefs that virtually compels him to perceive the market from a perspective that is always expanding with greater and greater degrees of clarity, and also compels him always to act appropriately given the psychological conditions and the nature of price movement. The most effective and functional trading belief that he can acquire is anything can happen. Okay. So aside from the fact that it is the truth, it will also act as a solid foundation for building every other belief and attitude that he needs to be a successful trader. So in these two paragraphs, the author is finally telling that, cementing the same thing. So because our inner beliefs, our inner thought process is very powerful, and that is what controls what you see, how you behave, how you interact with the markets. And if you don't have, it is extremely difficult in some cases. Uh, so if the strength of the belief is so strong, you will basically not do anything, something which violates that core belief. Okay. So, and that core belief is very important, right? And what is that core belief which you have? So that is the author is questioning, right? And the author is also suggesting that the first core belief which you should have in a market is that anything can happen. That is the core belief which you should acquire. You should always be telling that anything can happen. If I'm taking a trade, still it can go against me. And this is the it will act as a solid foundation for building every other belief, and this is the foundation for every belief, every attitude which you should be getting for a successful trader. So always be humble, always tell to yourself that anything can happen. Without that belief, his mind will automatically and usually without his conscious awareness cause him to avoid, block, or rationalize away any information that indicates the market may do something he has not accepted as possible. So if you don't have this particular belief, you will simply what we will avoid all the information which the market is telling us. We will simply because we think that we are always right. If he believes that anything is possible, then there is nothing for his mind to avoid because anything includes everything. This belief will act as an expansive force on his perception of the market that will allow him to perceive information that might otherwise have been invisible to him. In essence, he will be making himself available to perceive more of the possibilities that exist from the market's perspective. Okay. So if you don't have this belief of anything can happen, what will happen is if you have that particular if you don't have that belief, it will block the newer information which you will be getting. And if you have that belief, you will quickly take up these kind of actions. If you know that anything can happen, what will you do? You will predefine your risk. You know anything can happen, you will quickly cut your losses. And if you know that anything can happen, you will quickly, once you get the profit, you immediately take it. Okay. So you will be open. Most importantly, by establishing a belief that anything can happen, he will be training his mind to think in probabilities. This is by far the most essential as well as the most difficult principle for people to grasp and to effectively integrate into their mental systems. So the author is telling that you have to train your mind to think in terms of probabilities. And this is the difficult thing for most of the people will be finding it to grasp. So in this chapter, we saw about the market's perspective and how the market is always uncertain and how you have to make yourself available for when the market is giving you an opportunity. And the author is now trying to, the core of this chapter is the market is random, right? Market is it can do anything, and the successful traders what they do, and he also says why it is random, because each and any single individual can bring down the market. And he gave the example of how an arrogant trader kept losing, and he was actually a very fantastic technical analyst, but one person proved him wrong about his support, and he brought it still more down. And this is what the belief which you should have. And the successful traders, because of this particular belief that they know that anything can happen, what they do, they predefine their risk, or they cut their losses quickly, and or they take their profits quickly. These are all, they take their profits consistently. Okay. And if you don't believe, and for this to happen, you have to have the belief. And that is the most fundamental trading belief, is that anything can happen. Okay. And if you have this particular belief, then that will help you expand. Okay. That will help you expand and absorb and be open. And if you have this belief, you will automatically predefine our risk, we'll automatically cut our losses, and we'll systematically take the profits. And if you have this belief also, since you know that anything can happen, anything is possible, anything is probable, you have to start training our mind to think in terms of probabilities. And this is the difficult thing for most of the traders to grasp. So with this, this chapter the author is ending this chapter about the market's perspective. And with this, we also end this session. We'll continue the next session in the about reading about the trader's edge and how we have to think in terms of probabilities in the next session. So thank you. Thanks a lot. Bye bye.